Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, January 29th, 2014. This video is sort of an impromptu video. I've posted a lot of static charts lately, and gosh, haven't done a video since sometime late last year, so it's been a while. I typically try to publish a couple videos a month, and you know, right now with the recent developments in the markets, I figured I'd go ahead and do a video. Sometimes I can convey my thoughts a little bit more than the static post and the brief, paragraph or two below those. So let's go ahead and take a look, starting here with the S&P 500. This chart is, I didn't have time to go in and clean this up, so this is a very busy chart. It is very similar to the one that I have on the site under the live chart links page. That's at stockcharts.com. Or Stock Charts allows linking to charts, so that's why I'm using Stock Charts on all the live charts. So you can go ahead and visit that one. Again, this one has a lot of past trend lines and wedges and divergences drawn out, things that have played out in the past, and these were all posted before. So what we want to focus on here, this white uptrend line is the same uptrend line that I was highlighting and have been and still am inside the on that live chart link to Stock Charts. We had a recent breakdown. This trend line is generated off the November lows. And we have a touchback here. It looks like in late June. Another tag here in August, late August. We had this temporary breakdown. We had prices break below that trend line and then snap right back up. And this is very indicative of the trading type of chart patterns and fake out moves. Fake outs are referred to as a breakdown that a breakout in a stock or a breakdown that tends to reverse in the next day or so. And we saw quite a few of those last year, especially on the short side. I mean, that's a function of a very strong market. There was a lot of liquidity in the market and a strong bid underneath it. So either way, we did see quite a few of those. And so at times I will look at the most reactions, and every now and then you have to exclude one of these temporary spikes above or below a trend line, and that's what I did here. So that's where we're at, and currently prices are trading below that level. I also have had this uptrend line here. The purple uptrend line, as well as the one below, defined a previous rising wedge pattern that I was tracking back in, it looks like October or so. We broke above that wedge, and I figured that would be a temporary overshoot and the prices would come back down and through. And I was wrong. They've continued to climb well into, all into 2014 here. But right now they're coming back to backtest that line from above. So it may have been or prove to have been an overshoot of the wedge, and that's just a level to watch. This purple uptrend line should act as support, and to be honest with you, I believe I have that drawn a little higher, to catch that reaction high here. So we've actually come back and we've tagged on it the last 2 days. If we zoom in there, and again, as I said, I didn't have time to brush up these charts, but you can see it connects the initial reaction high, actually tags that reaction high here as well as that one. And then prices came back tested from above, and we've had 2 taps from above. So this is a support level to watch, and if we break below that, which I expect we do, that will then throw us back into that previous wedge pattern. This will all have proved to be just one big overshoot of the pattern, and what we typically see on wedge overshoots or overthrows is that prices will come back down inside the wedge and then impulsively break down to the other side, in the expected direction of the pattern. Now, this was a bearish rising wedge pattern because prices were moving up in that formation. We had negative divergences in place below. This is something else to point out. Early in the year or mid-year, I pointed out these divergences, expected a correction. Each of those did happen. If you look at here, we had some pretty nice pullbacks, and these white uptrend lines are what I call minor or sub-uptrend lines. They define the trends. We had divergence at each of these highs, each of these arrows, with the MACD or the RSI and many other indicators making lower highs, with prices making higher highs. So those did play out. Fortunately, these divergences in the bigger picture, my call for a much larger, 10, 15, 20% plus correction has not yet played out. although these divergences have only continued to build when looking at the bigger picture. So in other words, each one did play out for a small move, but what we have now, again, it's not so clear on this chart, is a much larger rising wedge with longer building, longer standing divergences. And if history repeats itself as things usually do, these divergences will play out for a significant correction. Of course, there is a possibility that prices continue to grind higher and burn through these divergences. I've talked on that pretty much throughout the last year. By burning through the divergences, if the oscillators and indicators make higher highs, especially sustained higher highs, sometimes we'll see a quick little punch above and then, on a wedge overshoot or something, and the prices fall back down. But right now, that is not the case. We've had divergences building. We're looking here at a weekly chart of the S&P 500. We're looking at the PPO, which is very similar to the RSI. I'm sorry, to the MACD. We're looking at 1226.9 PPO and RSI 14. And we've had divergences building on the index since early 2011, meaning prices have made higher highs in the S&P 500 while the PPO, RSI, just about every other indicator oscillator out there have made either equal or, in most cases, lower highs. And that is, multi-year negative divergence, just like we had coming into the top in 2002, 2007, 2008. And remember that divergences, these wedge patterns we're looking at, whether it's a bearish rising wedge pattern, bullish falling wedge, any other type of pattern, they're just as relevant on these long-term charts, the weekly and even monthly charts, as they are on a 15-minute or a daily time frame. The only difference is the expected move will be commensurate with the time frame. So we're looking at these very large wedges, and a simple measurement on a wedge pattern, you take the distance from the widest point of the wedge. So let's stretch that out about right here. This is just a rough estimate. And you add that to wherever the wedge breaks down. So let's just say hypothetically, I'm having a hard time grabbing, let's say this yellow trend line here, that's going to come in about right here. If prices were to fall quickly, that would be your measurement right there. And if you look at the horizontal line on my crosshairs, you see some nice support there. And that would take us down to 1275 on the S&P. At this point in time, is that my call? Absolutely not. First things first, let's watch these daily charts. Let's see where prices go. Let's see which support levels give way. But that is something to watch for, especially if this is a top. And remember, we're 5+ years into this bull market. So we've exceeded the average bull market over the last 83 years, I think it is. So this bull is getting old in the tooth, and we have a lot of technical evidence that shows we may see a big correction. I believe that it will be sometime here in 2014. I do know that I was calling for the correction to happen in the the third or fourth quarter. Most of last year, about the second half of last year, I had continually stayed on the site that, or at least a few times, stated that I believe a significant correction, meaning one of 10 to 20% or greater, would begin by the end of the fourth quarter of last year. Now, if we look at what's happened, that call technically, can it prove to be accurate? No, because we topped out on December 31st, believe it or not, last day of the year. The S&P closed at 1848.36. We went on to make a high on January 15th of 1848.38. That's 0.02% on an index of nearly 2,000 points. So statistically, that's a equal high. So maybe the market, one could say the market topped in December because we really didn't, other than 0.2 point higher, we didn't close any higher since then, and we are significantly lower right now. So again, the most important thing here is these divergences persist, and we're seeing some evidence now that there could be some more downside. So let's go ahead and dive in and look at just a few. I'm not going to go through all the top 10 holdings in the S&P 500 like I have in past videos, but I did want to look at a few of the key stocks. And let's just start out with the most important one. I've been posting quite a bit on Apple lately, and as with the market, I think, over the last couple years, I've made 3 calls for a top in Apple. One was the top. That was back in, Okay, sorry, I had to pause the video there. The chart wasn't loading. Looked like I had a temporary break in my internet connection. As far as Apple, going back, we were short here, shorted just before, within a couple percentage points of the high. And although at the time I cannot recall honestly if that was an official call for a lasting top, but I will say that I had downside targets that were hit. For those of you who've been on the site, you saw the Apple trade. That was, we were short at the top and rode it almost all the way down till we hit my final target. And for those of you that are new to the site and have heard a lot of bearish calls lately, I'm not a perma bear. I've had equal, if not more, long calls in Apple. We were long, I believe, at this point, a couple times off the bottom. Stopped out on one of those trades, but made some nice money by reversing near the lows and going long on Apple. I think it was over here. And so that was one call there that did prove to be the top and a beginning of a new bear market in Apple. And then twice late last year, I warned that Apple was looking toppy, and that was right about somewhere in here. We went on to make a marginal new high, and the second time was right within a couple percentage points here at the top. And so far, that has proved to be the top. And for all the reasons that I stated, which further, I don't know if that makes sense or not, but that further supports the case that we may see a lasting top in Apple. We had this rising wedge off the bottom. And again, reference the charts, look at the notes, go into the live chart links, and we can take a look at it here, a similar chart. There's a case to be made that I've made in the past that this may be a counter trend bounce, or in other words, a cyclical bull market and more of a secular bull market in Apple. And one of the things that I look at here, I cited going back to the daily chart real quick. I cited the Fibonacci retracements. We hit, I think it was a 61.8, or was it the 50% fib retracement off the highs? I don't have the fibs on this chart. You can see that on the daily charts. Sorry about that, folks. But the 200-day moving average, which is also the 40-week moving average. And when you're looking at long trends, I really want to focus on the weekly chart, because to avoid being whipsawed or getting a false sell signal, if you wait for a close on the weekly chart, you're more likely to get a solid signal. So if you look at the price history here, this is Apple going back. We're looking at a 10-year chart, and look how well the bull markets in Apple were defined by prices being above the 200-day or 40-week moving average. Again, this is a 40-week moving average because we're looking at a weekly chart, so a 40-period moving average. We had a bear market in Apple back in '08. This doesn't look like much because of the scaling. I'm using a log scale chart. If I put it to a linear scale chart, it would look like a much bigger move, and that was a very big correction in Apple, and that was in fact a bear market. Didn't get you right into the top, but it confirmed once you broke below that 40-week moving average, the stock was in a bear market, or let's just say a major correction, downtrend at that point. Got back above, stayed there for months. Again, a weekly chart, so every candlestick represents 1 week of trading action. So this is a span of looks like 3/4 of a year, at least half a year. Got above that trend line and then broke down again, and this defined this bear market here, the 2008 to 2009 bear market in Apple. And since then, since early '09, Apple was in a bull market defined by that uptrend line. I'm sorry, the 40-week moving average, hammered off at one point. There was a great buying opportunity back in, it looks like late April or early May. It looks like early May of 2010. Nice hammer. That must have been the flash crash back there. And Apple continued up, broke that 40-week moving average, began the bear market here, which also coincided with trend lines. I don't look at any one thing in trading a stock. I look at trend lines, Fibonacci levels, moving averages, Bollinger Bands. There's things that aren't on a lot of the charts I post. I try to keep my charts pretty streamlined, but a lot of this goes into play here. Now, back to what happened here, we had this trend line break. This is a long-term secular bull market trend line, which Apple broke below back in late 2012, just as it broke this trend line here back in late 2008. That trend line broke. Prices also dropped below the 40-week moving average. What happened before that trend line broke? Just like back in '08, we had divergences leading up to that trend line break, and we had we had divergences, or I should say, well, we don't have them now. Prices are making lower lows. We did have those up to this point. Yes, we had those divergences in place up to the highs. I'd have to remove these trend lines here. It was these smaller divergences right here. Let's get rid of these. They're not as relevant right now because prices have made lower lows along with the indicators and oscillators. So that is something I'm watching. And we go back to the 200-day moving average here on a daily time frame, which again, this is the same line as that 40-week moving average. It's only a little faster here. We're looking at it on a daily time frame, and prices have broken below. On the gap down the other day, we broke right below that line and continue to trade below. Now, zooming in a little bit closer to the 2-hour time frame, this is a chart that I've been posting since a few weeks ago with my call for a 6% drop in Apple, 4% drop in Exxon Mobile, and a 5% drop in the markets. Well, what happened? We hit my target, and it took to that earnings gap to get there. I'm a believer that all this is priced into the charts. Some might say, "Oh, well, lucky call," or they missed earnings, or they had a bad forecast, or whatever reason the street didn't like it. Doesn't matter. It was in the charts. And the charts always pan out, no, but more often than not they do. Now, the important thing is that target level was support. It was a key support level defined by all these reaction highs here, as well as, reaction lows, prices bouncing along from this previous reaction here. So this reaction high, and I can even go back longer, and I believe there are more reactions on this trend, on this horizontal line here, that level around 513-ish. But the most important thing is that level was support. Prices gap below support. Once support is broken, it becomes resistance. So Apple is in a precarious or a bearish technical posture right now, because until and unless prices can regain that level, make a sustained break back above, now we have this overhead resistance to deal with. Just like I pointed out yesterday, XOM, same story. Here is my target level, which was support defined by these reactions here. Prices broke below, came back to challenge it, and my expectation now would be a continued move lower. Of course, if both Apple and Exxon Mobil can take back these lines, that would be bullish, and I would have to re-guess, my current thinking. So that's those two. Okay, I might as well stick with XOM while I'm here. This is a weekly chart of XOM. From a longer term perspective, I remain bearish. I've been bearish on Exxon Mobil for most of last year. We had this breakdown. This is a long-term trend line. Exxon Mobil, unlike most big stocks, especially the top holdings in the S&P 500, most of those bottomed back around March of 2009 when the market bottomed. The last bear market ended. Exxon Mobil happened to put in its final low, mid-2010. So what we're looking at here, it's had a pretty well-defined uptrend line, this rising wedge pattern that I've been highlighting. And all along the way, I've highlighted the divergences. I've had to make adjustments as we go. These were, we had negative divergence here. But did it play out for a correction? Absolutely. If you look at the horizontal line, this was the peak. We had a sharp correction. Very, very lucrative trade, especially for such a liquid mega cap stock. You're not looking for 20, 30% corrections in an Exxon Mobil, especially if the broad market's in an uptrend. But the point is, these divergences did play out. And, as time went on, we had other divergences that played out. At this point in time, we still have divergences. And most importantly, I like to see these divergences confirmed. If you look closely here at the PPO, it is turning down and poised to make a bearish crossover, meaning the fast line crossing down below the slow line. That is the point at which I say divergences are actually confirmed. In other words, if the PPO were still moving up sharply, the fast line well above the slow line pointing up, then I would say we have potential divergences, and it could just continue to go up. But once we cross down, those divergences are in place. These are momentum indicators. So once the trend changes to down, that's when you get the crossover. So, and odds are we'll continue to go lower. So what's happened with XOM? We did have a breakdown of that wedge late last year. Prices shot back up. The market rallied strong into year end, so this doesn't surprise me. And sometimes the charts don't play out as expected. I did expect more on this breakdown at that point in time. I've had Exxon Mobil as a short, still have it as a short, both personally and on the site. And since then, prices went up, they broke out to this new high. Now that, from a technical perspective, is very bullish. All-time highs in a stock like this. So undoubtedly, you had a lot of traders pile in. Now, what's missing in that so far? Well, first of all, volume. You want to see on a stock, especially a well-watched stock like Exxon Mobile, break out to new all-time highs. You normally would see a surge of volume as new buyers come into the stock. Not only did we not see a surge of volume, volumes continue to just drop off. So there's a good chance that new high breakout fails. And if it does, that is what's referred to as a bull trap. You did undoubtedly have some traders pile in, but so far we're back to challenging those highs. You can look at this trend line that defines those previous highs back in 2007, 2008. And if prices move, significantly below that line, which is also the apex of the wedge, keep in mind, we're probably going to go lower. And, I've talked in the past about this long-term chart. This chart goes all the way back to 1984. So this is a very long-term chart with a nice, well-defined uptrend channel that Exxon Mobil has been in all these years, which the stock broke down from back in 2010 and has just been really skating along, hugging the bottom of that channel since then. Not healthy behavior. The fact that it is going up and just recently made a new high, you can't knock that. Overall new highs are bullish anyway. You want to spin them. However, there are warning signs in place, such as these divergences here on the rate of change, the RSI, the PPO. These are significant divergences, multi-year divergences. And again, we're viewing a monthly chart. So this tells me that, the next 5 years in Exxon Mobil are probably going to be a lot tougher than the last 5. So we'll just have to wait and see on that. As long as I'm picking on big oil, let's look at CVX. I've talked a lot about this. There's a ton of static posts, so you can reference that. Just use the tag. For those of you new to the site, on the very right-hand side of the homepage, there's a drop-down box that says Select Tag, and you can select any symbol. So just hit the drop-down box, type the letter C on your keyboard. That'll bring you down to the C's. Scroll down a little further to CVX, and there all the posts on CVX will be there in chronological order. With all the static charts. This one just shows these trend lines. The blue primary uptrend line is what I'm looking at. To me, this is a magnet that prices will visit sooner or later. Every few years, sometimes every decade or so, they come back to visit this trend line. But it's been in place since early 1985. Last time we revisited that trend line was in early 03, and prices have had these. If this is the overall primary uptrend line, we have these minor, if you will, this is a monthly chart, these are multi-year, but minor uptrend lines usually form with wedges, almost always with negative divergences in place at the top, and now is no different. We have another bearish rising wedge pattern, pretty well defined uptrend line, negative divergences in place. You just have to have patience with these trades. This is the CVX daily chart here. This to me looks like one of those old steel bridges you'd see in Pennsylvania or somewhere. You can call it a rounded top, whatever you want, but the bottom line, here's the bottom of the bridge. So when that prices break below this line, more than likely that bridge will collapse, and this is an initial target zone. Again, revisit the sites for the official targets. And for those of you that are long-term traders and are comfortable with the short side, I think this one has a way to go, and it's probably put in a long-term top, or will at some point in 2014, if it hasn't done so already. Here's GE. Won't spend too much time. Here's a nice uptrend line going back to early 2012. Prices are on that uptrend line now. We broke out to this new high here, multi-year high. Prices are quickly. Look at the impulsive selling following that breakout. This is the action I'm seeing. If we had that low volume going into the end of the year, bullish sentiment was just through the roof. All-time or multi-year highs, and I think we had a lot of breakouts, and we're seeing money pile out of those quickly. In other words, they're not sticking. There's no follow through. But again, it's back at support. You want to take the glass half full approach right now. You're looking at a lot of key stocks. If you don't put as much stock into the divergences as I do, I don't have them drawn. In fact, GE doesn't really have that steep. I could draw some divergences here on the RSI. And this is a 2-day period chart, by the way. But my point is, here's a stock at support. So if you're a long-term bull in this market in stocks like GE, you buy right here. We're at horizontal support marked by this line as well as this uptrend line support, and you put your stop just below. And if you're a bear, you wait for a confirmed breakdown of this level. And here's a daily chart zooming in a little bit better. And yes, there were divergences at the top. I haven't drawn them out here, but as you can see here, there's the MACD. Same thing on the RSI. I don't need to put that line there against prices making a higher high. So I'm seeing, this is a theme I'm seeing right now. A lot of the recent breakouts and these moves into year end, early 2014, were made on low volume and negative divergence. In addition, look at the selling. I don't know if you can pick that up. I have my volume bar is sort of de-highlighted or tuned down here a little bit, but there's a lot of selling on that. So keep an eye on GE and, just about everything we go through. Here's Google. I've talked extensively about these Fibonacci fan lines. They never cease to amaze me how well, I was talking about these for months throughout most of last year, how well prices have acted on and off these levels. And since that most recent big gap up, we've done nothing but skirt under the underside, and I have not touched or modified these fib fan lines in months. And again, prices have reacted so well. Now, what it means from here, I don't know. Google is one of the stocks. I use a lot of their services. YouTube, I have an Android phone. They own Android software, YouTube, all those. Great company. And the thing about these fib fan lines, we've already hit the very last one in the sequence, and that may have been the end of it. But just something to keep an eye on. We do have these negative divergences here. You see prices moving much sharply since that gap up back in, looks like October or so. Much higher high in prices against lower lows in the MACD and RSI. So again, red flags on just about every one. I won't go through all the top 10 holdings in the S&P, but I wanted to point out that the risk reward at this point in time, longer term, intermediate, short term right now, and longer term, favors the short side, or at least a lot of caution on the long side, in my opinion. Okay, I could talk on these charts all day, and I could go through each one of the top 10 holdings in the S&P and show you a lot of bearish developments, a lot of stocks at key support, maybe under, recently broken support on the shorter term time frames, and now that's overhead resistance, a lot like I talked about on Apple and Exxon Mobile. So the point is, just keep an eye on the market, keep an eye on these key stocks, and the next few weeks here could be important. Okay, folks, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.